right, let's talk about investing. Most people think it's this super complicated game, something only the pros on Wall Street can ever hope to win. But what if I told you the real winning strategy is actually incredibly simple? We're going to break down how you can invest successfully. And it all starts with getting your head around one key idea. And this quote, man, it just gets right to the heart of it, doesn't it? It explains why so many of us are kind of scared of the stock market. It just feels like a casino, like the odds are stacked against you before you even sit down at the table. It feels like a game you're basically set up to lose. And honestly, for a lot of folks, that's exactly how they treat it, like a trip to Vegas. They're chasing those quick, flashy profits, they're trying to time the market perfectly, and, well, more often than not, they end up losing. They're playing a game of chance that they just aren't equipped to win.
But here's the thing. What if there was a way to basically guarantee a profit, over the long term? There's another way to play this game, a method that completely flips the odds back in your favor, and it's pretty much guaranteed to build wealth over time. The best part? No crystal ball, no fancy finance degree needed.
So, to really get the winning strategy, we first have to understand the losing one. I know it sounds a little backward, but honestly, the biggest investing mistakes, they teach us the most valuable lessons about what not to do. Okay, so this is the classic profile of what we'd call a bad investor. They're driven by two super powerful emotions, fear and greed, right? They hear about some hot penny stock or a tech company that's already shot up 50%, and FOMO kicks in, they jump right in. And hey, they might get lucky once, but then they immediately lose it all trying to catch that same lightning in a bottle a second time. So really, it boils down to two paths you can take. On the left, you've got the gambler. They're emotional, chasing that insane 1,000% return, and just riding a total roller coaster. But on the right, you have the optimal investor. They're rational, they're patient, they're diversified, and they're focused on proven long-term returns. It is a completely different mindset. And this quote, this really puts it all into perspective. I mean, think about it. Putting 10 grand on green at a roulette table and winning, that doesn't make you a gambling genius. You just got insanely lucky. It's the exact same thing with picking one single stock that just happens to skyrocket. Luck is not a strategy. Okay, so if gambling doesn't work, what does? Let's get to the solution. And it's a simple, really powerful method that was pioneered by an absolute legend in the world of investing. Meet John C. Bogle. This guy founded Vanguard, and he did something that was, and still is, almost unheard of in finance. He actually put the average investor first. He's widely considered one of the true good guys in the whole industry. And his impact? I mean, it was just staggering. Bogle's whole philosophy of low-cost investing is estimated to have saved everyday investors like you and me around, get this, $1 trillion in fees. $1 trillion! That's money that stayed in the pockets of ordinary people instead of going to Wall Street. Now that is a legacy. So, his big idea was this, the passive three-fund portfolio. And the logic behind it is just so beautifully simple. Instead of trying to find that one winning needle in a gigantic haystack, why not just buy the entire haystack? It's a strategy built on simplicity and some seriously powerful diversification. Okay, so how does this thing actually work? What's the engine that makes your money grow? Well, it all comes down to the relationship between risk, return, and, believe it or not, burritos. Yeah, burritos. We'll get to that in just a second. But first, we've got to understand a really key difference here. The best investment, in hindsight, would have been buying something like Dogecoin at the absolute perfect time for a mind-blowing return. But let's be real, the odds of you actually doing that are practically zero. What we're after is the optimal investment, the one that gives you a predictably high return for the amount of risk you're willing to take. And this chart here shows it perfectly. Just think of it like a ladder. Down at the bottom rung, you've got cash. Zero risk, but also zero return. Then you step up to bonds. You take on a little more risk, and for that, you get compensated with a higher expected return. Step up again to stocks, and you get the highest expected return of all. Why? Simple. because you're taking on more risk. And in a functioning market, you get rewarded for that. This right here, this is the engine of wealth generation.
So why do you even need that return in the first place? Well, because of this right here, inflation. It's this constant, silent force that's always making your money worth less and less over time. I mean, that Chipotle burrito that costs what, $10 today? In 2077, it's going to be $50 or more. That's not a guess, it's a guarantee. So if your money isn't growing faster than inflation, you are literally losing money every single year.
All right, let's put all the pieces together. What does this optimal portfolio actually look like? Here's the simple, proven blueprint for long-term success. It's really this simple, a 3-fund portfolio. That's it. You get one fund for the entire US stock market. That's for your growth here at home. Then you get one for the international stock market, so you can capture growth happening all over the world. And finally, one for the bond market, which gives you stability when the stock market gets a little crazy. That's the whole shebang. You're now diversified across thousands of companies worldwide. Let's make this real for a second. Take a fund like VTI, that's its ticker symbol. It's a US total stock market index fund, so with one single purchase of VTI, you own a tiny little piece of over 3,500 different American companies. Just like that. Now here's the really clever part about how these funds are built. They're what's called market cap weighted. All that means is the biggest, most successful companies automatically get the biggest slice of your investment. So as you can see, giants like Nvidia, Apple, and Microsoft, they make up a huge chunk of the fund. And the best part is, the fund rebalances itself automatically, so you're always invested in whoever the current winners are. So the whole philosophy really just boils down to these 4 simple steps. Step 1, buy the whole market using low-cost index funds. 2, diversify across the US, international markets, and bonds. 3, and I gotta say, this is the hardest part, you have to hold on for the long term and just ignore all the noise. And number 4, keep your fees as low as humanly possible. We're talking expense ratios, because every single dollar you pay in fees is a dollar that's not working and growing for you. And this right here, this quote just captures the beautiful irony of this whole approach. You could have someone who sets up a simple portfolio and literally forgets they even have it for years, and they will still probably outperform 99% of the day traders who are glued to their screens every single second. It's wild, but when it comes to investing, less is truly more. Which brings us to the final and most important question. Look, the strategy is simple. The evidence for it is overwhelming. The hard part isn't knowing what to do, it's having the discipline to do nothing. To resist that constant urge to tinker, to trade, to chase the latest hype. The path to building real wealth is right there. It's crystal clear. So the only question left is, can you do nothing?